Good morning. So we're starting on chapter 5 today, and I've got your handouts all passed out. If I missed anybody, please let me know. Wanted to let you know the chapter 5 homework has been moved back to Monday night. There were a number of people who opted out of the book bundle, only to be surprised that they would be charged. Unfortunately, it looks like double the amount they would have paid with the book bundle. So I apologize, but this gives you, if you needed a little time, a Friday paycheck or something like that to get the book ordered, then you can order it and get your homework completed. Make sure to keep your same information, your same number so that it keeps your same account, but you have to go through Cengage now and register it. Somebody asked me if they should register for 2 semesters if they're going to have another Cengage book. My thoughts were the difference of it, and I'm not sure exactly what it was, but the extra semester was about $70. I said you're probably better off not doing that, because if you have another 3-credit course where you're using Cengage, then it's only $70 under the book bundle, or $72. So it's $2 more than you would pay. Because my understanding right now, the book is $130 with the access to CNOW V2. And if you want to buy it for 2 semesters, it's $200. So that's, if you're not sure if you're not going to have another class that's going to be using the book, then I would wait on doing the 2-semester one and just spend the $2 extra with the book bundle for next semester. Okay. Any questions? Okay. So we have your handout today, and we're going to talk about operating cycle for a retail business. Now, you guys don't have this picture, and I didn't draw it. You can either draw it in, or you can copy and paste it. This handout is out there electronically. The other copy will be out once I finish this class. But basically, we've been talking about manufacturing, and we've been talking about service companies, but this kind of introduces us into retail. With retail, you're buying inventory and then you're selling inventory. And so the cycle is, you're purchasing merchandise, you're selling it, you're collecting the cash from the customers, and then it goes around and around again. Now, sometimes you have accounts receivable, sometimes you don't. Businesses like Best Buy that use credit cards, for the majority of their purchases, debit cards, those aren't considered accounts receivable. Those are considered cash, and then they just withdraw or deduct the fee for the credit card, whatever they charge. So that's where what's that? Oh, yep. Sorry, I missed you. I didn't see you come in. My fault. No, this is chapter 4, so we're on 5. Yeah, well. There's not a lot that's different in this chapter. I'm going to talk about some of the key words that differentiate a merchandiser from some of the other companies. We're going to talk about sales, and we're going to talk about inventory, and we're going to talk about returns. So if you have your chapter 4 notes, I want you to go back and fill these out, because I found a lot of the students struggled with that. Oh, by the way, did anybody need to turn in their group assignment? If you need to turn in your group assignment, please do that now. Thank you. Thank you, Quincy. Quincy, I'm going to put your name on it. Thank you, Ronnie. Okay, so merchandise company, like a manufacturing company, is going to have revenues. And so it can be merchandise sales or revenue, however they report it. The book kind of sticks on terms, and I'm not sure that I would worry about that too much. Sometimes it's fees earned for service companies. I don't notice that they all stick to one specific term. So what does a merchandiser have that's like a manufacturer? They could, but they're selling what? Products, right? Or goods. So they have less cost of goods sold. Give me 1 second, please. Thank you. And this equals gross profit. So it's not too much different than what we've seen. So keep that in mind. It's important. These are just the basics. We're going to see more complicated statements. You won't be asked to do a statement. I don't think trying to squeeze everything in during a test time is a good way to do that. You may be asked to on one of the in-class or group works. So that's where you have a little bit more time. Okay, so it's important to get that basics down. And you know, from the group problem, you have to recognize what belongs where. So it's important to start thinking about the accounts, right? Do I know where my accounts belong? Okay. Now we have a few practice questions here. Which of the following is a characteristic of a perpetual inventory system? So take a second to read it. Right. The answer is C. Cost of goods sold is recorded with each sale. So with a perpetual inventory system, we're going to talk about it a little bit more. The perpetual inventory system adjusts the inventory and the cost on every transaction. Now we can do that with computers. Before we could not do that. When a periodic system is used, take a minute to read that one. Okay. Periodic inventory system is different in that we don't make the adjustments to the inventory or figure out what we have in inventory for certain until the end of the year. Goods in the accounting records are kept separate, or excuse me, records for accounting are kept separate from the physical inventory records. And so everything is updated at the end of the period. So the answer here is a physical count of inventory is required at the end of the accounting period to determine cost of goods sold. And that's where that cost of goods sold formula comes from, right? Right? You want to find your beginning inventory plus your purchases minus what was used minus what was returned. And these are us returning it, right? Minus the ending inventory. So we can't figure out what our costs of goods sold are until we have all of these other components, and ending inventory gets done when the physical inventory is taken. Okay, now we'll talk about some notes. Perpetual inventory system. Each purchase and sale is recorded in the inventory account. The amount of inventory available for sale and sold are continuously updated. Okay, in a periodic system, inventory does not show the amount of inventory available for sale or sold. Physical inventory Physical inventory is performed at the end of the year or accounting period. To determine ending inventory. Sometimes they only give you information about the inventory account when we're talking about a merchandiser. And you want to say, well, how can I figure out how much was used? So for an inventory account, beginning inventory plus your purchases minus your ending inventory equals what was used. So on the last chapter 4 group in class work, there was a section that took the inventory account and you had to figure out what the cost of goods sold was. And so here used, if it's the only product, you know, it would be cost of goods sold. Right, if they only have one inventory account, that would end up being your cost of goods sold for a merchandising. Instead of B, I should say equals. Everybody caught up, or anybody need another second? Just kind of give me a little wave if you do. Okay. Credit terms. So these are the terms between buyer and seller that provide when payments should be made. For purchases on account. Okay, so with credit terms, you kind of have a couple different terms, right? So if payment is required on delivery, the terms are considered what's called net cash. Otherwise, the buyer is given a credit period. This varies by company and industry. Now, a little note here. The book says the credit period begins when the date on the invoice. In practice, some companies will take the discount based on the delivery date. If I invoice you for a sale that's going to ship tomorrow and then get delivered on Monday, then you have at least 3 business days there and 5 total days that you might feel like, hey, I didn't have this merchandise. How could you expect me within that term? And when you talk about small terms between businesses like this, usually you can say, hey, it starts on the date it was delivered, not on the date that it was invoiced. But no, if the book asks, is it paid within the cash discount period, start with the invoice date. If the invoice date is not there, then use the day of delivery. And the invoice date meaning sale date, if the sale date wasn't there. All right. Any questions? Purchase discounts. All right. These are discounts offered by the seller to the buyer. It can be for bulk purchases. Like if you buy 1 million of them, we'll sell it to you for $2 a widget. But if you buy 5 million of them, we'll sell it to you for $1.50 a widget. So that could be a bulk discount, right? Companies are willing to make some price adjustments if you're purchasing for large economy of scale. So they can be for both purchases. And for early payment. Discounts are usually shown something along those lines. And the first number is the percent discount. The second number is if paid within those days in cash. And the third number is the full payment date if not paid early. So this is read as 1 10 net 30. In English, although I'm not an expert on the subject, customer or the buyer can take a 1% discount if paid within 10 days, or has to pay the balance, the full balance, within 30 days. Okay, customers should always take the discount. Why? And so the question is, how many 10 or 20-day periods are there in a year? And I'm using 10 or 20 just because that's a number that's kind of used in the field. So how do we figure that out? 360 or 365. 360 is kind of used as a mathematics shortcut, so you don't have to put 365 in there. They just use a nice even number. And then you divide by the discount period. So in this case, if we took 360 and we divided by 10 days discount period, that equals 36 periods. If we multiply that by the discount, we get an approximate yearly discount. So here, 36 periods times 1% equals 36% annualized. So if I'm giving you a 1% discount over 10 days, really what I'm doing is saying, if you were financing that for a full year, I'd actually be giving you a 36% discount. So you should take the discount always. Even if you are cash strapped and you need to borrow the money, typically businesses are able to borrow cheaper than 36%. Any questions there? Okay, now we're getting into purchase return. And so a purchase return is just straightforward, returned purchases for whatever reason. Remember, we're talking about the buyer here. We buy it, the material is damaged or not up to our quality standards, and we return it. Purchase allowance is an is a credit for damaged or otherwise not 100% inventory purchases. So if you go to Best Buy and you look at a refrigerator and you buy that refrigerator and then they deliver it out to your house and you notice that the side's got a dent in it. Now you don't care because you're pushing it into the cabinets, but still, it's not 100%, right? So this would be where they come to them and say, hey, you know, we have to make a little fix on a dent or something like that. Can you give us a purchase allowance? And they give you a credit for it. They call it a debit memo from the seller side. Customer allowances. This is a credit against accounts payable because the customer has not paid for the merchandise yet. Customer returns. So keep in mind when customers return merchandise, the selling company has to credit the accounts payable for the customer or issue a cash refund if paid. And a little note here, company also needs to return the inventory to the inventory account. Sorry, this is inventory return. Okay. The account that offsets the inventory return in the journal entry is estimated inventory returns. Any questions on those? Words, that's bad English. Redundant. Okay. Good. Okay. Freight in or shipping, FOB shipping point. Usually shipping costs are paid by the buyer and title, which is ownership of the goods, passes on the date the goods are shipped by the seller. Now, why does this matter? We do inventories at the end of the period, at the end of the year, right? If we are continuously operating as a business, then we would expect that we have some purchases of inventory that are occurring right around the end of the year. And as a result, when you're calculating your inventory, you have to include everything that you've paid for and shipped that hasn't arrived yet. So it could be substantial in terms of what you're required, depending on the size of the company and what they're doing, to report. So it's important to get your inventory correct to make sure that these purchases are added to the inventory. And just a little reminder, freight or shipping in okay, and that's just a reminder, freight or shipping costs for inventory are added to the cost of inventory. So if you paid $1 million for a truckload of inventory, and then you had to pay $500 or $5,000 to get it shipped, the cost of that inventory would be $1,005,000. All right. FOB destination, shipping is usually paid by the seller, and the title, which is ownership of the goods, doesn't pass until the goods are delivered and accepted. Okay, it looks like we're good here. So we have I think I left this chart at the top of the next page for you. Journal entries to record customer refunds and allowances. And so we talked about a couple different types. One, are you going to pay a cash refund? Or are you going to provide a credit memo for accounts receivable? And so if the customer returns, sorry, does not return inventory. So this would be an allowance. The cash refund would be debit, customer refund payable. And a credit to cash. Bless you. Bless you. If they haven't paid for it yet, so we're going to process it to accounts receivable. We're going to debit customer refunds payable. And we're going to credit cash. If the customer returns inventory, two entries. We have a debit customer refunds payable. And a credit to cash. And to correct our inventory, actually seller inventory, we debit inventory and we credit estimated inventory returns. If it's not cash, then it's still pretty much the same entry, except for we're substituting accounts receivable. So debit, customer refunds payable. It's a credit cash up here. This should be accounts receivable. Fix that. I'm sorry. Same thing here, accounts receivable. And then debit inventory and credit estimated inventory returns. When inventory is returned, make sure to report it at the net cost of goods sold. The net cost of goods sold equals less any discounts offered or taken by the buyer. So what does that mean? That means if the buyer has already paid for it, keep in mind that you have to reduce the inventory by what you reported it as. So if they had a discount on it, you have to make sure that you adjust it. Okay, so let's look at an example that I'm going to walk you through. Okay. On December 30th, Burroughs sold $12,000 of merchandise to the Wall Company on account with two terms, 210 net 30. The merchandise cost Burroughs $8,000, right? So here we have the sales price, the discount, and the cost of goods sold. And then it says, on January 3rd, Wall determines that a portion of the merchandise received does not operate properly. And Burroughs issues a credit memo for the returned items. The invoice amount of the returned merchandise is $3,000. So this is related to sales. And this is related to our cost of goods sold. And we want to journalize the entries to record the December 30th sale and the January 3rd return. And so I'm going to make a note here. We want to record the sale at the net we expect to collect. And so here we would have accounts receivable, and that'll be 12,000 minus 12,000 times 2%. Bless you. And so that amount comes out to be 11,760. So what are they doing there? They're assuming that the buyer is going to take the discount. And so if they're assuming the buyer is going to take the discount, they should only report the net sale. And then this would be a credit to sales or revenues. And merchandise sold. The 11,760. And then we have to report the cost of goods sold. We have to get them out of inventory, and cost of goods sold is an expense, so we're going to debit it. And we're going to credit inventory, and this is for 8,000. So keep in mind, when you sell inventory, you have another entry. Record cost of goods sold. Okay, any questions there? All right, so now we're on to the January 3rd return. It says that it determines a portion of the merchandise received does not operate properly. So we have 3,000 and 2,000. So we're going to debit customer refunds payable. And this will be the 3,000 minus the 3,000 times 2%, because we already assumed they were going to take the discount on it. And we're going to credit accounts receivable. And so this is 2,940. Sorry, that doesn't go in the account. Why it would make that so big? There's nothing in there. And 2,940. But we have to take the inventory back as well. And so we have to debit inventory and credit estimated inventory returns. And we do that based on their cost of 2,000. And then it says on the 6th, the customer paid for the items. And so we would have a debit. What are we getting to cash? And this amount would be the 11,760 minus 2,940. And so that gives us 8,820. And we're going to eliminate their accounts receivable. Okay, so we started out and their original accounts receivable is here, right? And that debit of 11,760. So initially when we sold it, we said that's what you owe us. But we said, uh-oh, some of it was not up to standards, so we're going to return that amount back to accounts receivable. And so in my accounts receivable for their account, you have a debit and a credit. And so you would net those, the 11,760 to get the 8,820 and how much cash they owe you. Good question. Any other questions? Okay, let's jump to the next page. All right. So this would be recording inventory transaction. Whoa. Inventory transactions. Okay. So in your inventory account, you'll have beginning inventory, which is last year's ending inventory. Hello, everybody's home. somehow tied these two things in together, and that's annoying. Okay. Then we add purchases, net of discounts. We add freight or shipping in. Add customer returns. Purchase returns and discounts. Sorry about this formatting break. I expect it to copy over this way. So we've got on the credit side of it, and then cost of goods sold. Estimated returns for inventory would be an adjusting entry for estimated customer returns. And then what gets credited to it is actual customer returns. And then your cost of goods sold, you debit cost of goods sold. And you credit the adjusting entry for estimated customer returns. So what type of account is inventory? Correct. Asset. Estimated returns for inventory, also an asset. And cost of goods sold. Is it an asset? Is it a liability? Do I owe somebody that? No. What is it? It's the inventory I've sold, right? So it's an expense. Are we ready to go to sales taxes? Okay. Customers, or excuse me, companies are required to collect sales tax on merchandise sold to the end user, not business to business for purpose of resale. So when Whirlpool sells ovens to Best Buy, Whirlpool doesn't charge them sales tax. But when Best Buy sells it to you, they charge them sales tax. And the entry to account for sales tax would be a debit to cash for the sale plus any taxes. And then you would credit sales or revenues. And this would be for the sale price. And then you would credit sales tax payable for the sales tax. Any questions there? Okay, so now moving on to learning objective 3, analyze and post adjusting entries for retail. And so you have 2 types of adjusting entries. The first is for any inventory shrinkage, which can be lost, theft, damaged. So you would make this type of entry if you're a company like Target, and some things get damaged, some things get stolen, whatever the issue is at the end of the period. This is usually not a huge entry related to how much inventory you had, but you still want to fix the inventory. You want to get it right. And so what you would do is you would debit cost of goods sold, and you would credit inventory. And this is in the case that inventory is overstated due to lost, theft, damages, etc. The second entry is to estimate returns and allowances at the end of the accounting period. Which is comprised of 2 entries. And so if you're wondering how we do this, we estimate this based on past history of returns. Because companies are required to record expenses in the period incurred. The first entry reduces the sales account. And creates the customer refund liability. And so that would be sales, debit to sales, credit to customer refunds payable. The second entry creates an estimated inventory returns account. It's going to be debit, estimated inventory returns, and credit cost of goods sold. Now, remember, sales is a revenue account, right? So its normal balance is a credit. So because we've debited it, we've reduced the sales amount. We've credited customer refunds payable. So we expect to have a liability related to things that are returned. Second is we want to have our inventory kind of close. And with those, we expect some inventory returns, which would reduce our cost of goods sold expense. And so we're reporting it all in the period, and that's why we're making adjusting entries. Sorry, that. So here, this would just be sales. This is just in form, but it's the same thing. So we're going to leave with this, and you don't have to write this down, but this is a multi-step income statement. Now, I pulled up other income statements before and showed you that for the most part, businesses aren't putting all of this detail in there. They're just going to put selling expenses, 70,820, and they're going to put administrative expenses, 34,890. But when you're preparing reports within the company, a lot of times they want to see this detail. And so you can prepare it like this, and this is considered a multi-step income statement. You can see anywhere that I have steps to get to different numbers, that's considered a multi-step income statement. Whereas single step can be just revenues minus expenses. All right, so we'll pick up here. Next class. What's that? Oh yeah, give me 1 second. Have a good weekend.